It is February 7th, 2026. And as we look at the reports coming out of Abu Dhabi right now, I mean, it's a struggle to even call this a peace summit.
Well, it doesn't read like one.
No. We have the US, Russia, and Ukraine at the same table, finally, after 4 years of war. But the leaked documents, they just don't feel like a treaty.
No, they read like a distressed asset sale almost.
That is the perfect way to put it. I've been going through this 28-point plan, the US draft that's driving things, and the language is so transactional.
That is the defining feature here. We're not talking about, abstract justice or rolling borders back to 1991. If you look at the source text, the core is a freeze.
The line of contact concept, the plan explicitly says the front lines stay exactly where they are.
Which is the first bitter pill for Kyiv. It means Russia retains de facto control of Crimea.
And all the occupied parts of Luhansk, Donetsk, Zaporizhia, and Kherson.
Exactly.
And it's not just land. The NATO clause really stood out to me. It's not a maybe later.
It's a hard no.
A hard no. But, and this is where the business deal part kicks in, the U.S. offers security guarantees instead.
But you saw the catch on those guarantees, right?
Yeah, the compensation clause.
Right. The text actually says the U.S. will receive compensation for providing security. It isn't an alliance. It's an insurance policy. And you have to pay the premiums.
And those premiums are steep. It connects directly to the reconstruction fund. So the plan talks about a $100 billion fund using frozen Russian assets, which sounds good.
Until you read the fine print.
The fine print says the U.S. would receive 50% of the profits from the operation of that fund.
50%. It turns reconstruction into a for-profit venture, and it's tied directly to resources.
Yeah, the plan specifically lists cooperation on gas infrastructure and critical minerals, lithium and titanium.
Which sort of explains the whole U.S. angle. Procure the strategic materials, take a cut of the reconstruction, and, limit your own military exposure.
And in return, Ukraine survives, but with a much smaller military capped at 600,000 personnel, and of course with much less territory.
And that explains who you see at the table right now in the UAE.
Right, it's not career diplomats. It's Jared Kushner and envoy Steve Witkoff for the U.S.
Exactly. You send in the deal makers, the real estate guys, not the diplomats, for a deal like this. And they're across from Rustam Umarov and Russian military officials.
And look, they are making some progress. They just pulled off that big prisoner swap yesterday.
314 people, yeah. That's the first one in, 5 months?
So that builds some confidence, but we have to be realistic.
Of course. Secretary of State Rubio even said that while the list of disagreements is shorter, the ones that are left are the most difficult.
He has to be talking about the administrative borders issue. That seems to be the major sticking point.
That is the red line. The U.S. plan says freeze the lines, but Russia is demanding Ukraine hand over the entirety of those 4 annexed provinces.
Even the parts Ukraine still control, the cities they're still fighting for.
Yes. They want Ukraine to just voluntarily retreat from territory they haven't lost on the battlefield. For Kyiv, that's just Geshemity. It's political suicide.
So why are they even still at the table?
Economic exhaustion on both sides, really.
Yeah.
Look at the Russian data in the briefing. Inflation is at 6%, interest rates are at 16%.
Their economy is overheating.
It's crumbling. They need sanctions relief just as badly as Ukraine needs security. And that's the leverage here.
Which brings us right back to the beginning. This whole thing is transactional. It feels like peace is being bought and sold with land swaps, mineral rights, and profit-sharing deals.
It might resolve the immediate violence, sure, but it leaves a pretty massive question, doesn't it? If peace is built on resource extraction and financial contracts instead of mutual security, is it actually peace?
Or is it just a commercial lease that's bound to expire? That's a heavy thought to leave you with. Thanks for listening.
Stay curious. Our Europe is mortal. It can die.
Wow.
That's Emmanuel Macron, and he's not being poetic. He's talking about geopolitics.
Cold, hard reality.
Exactly. Today, we're doing a deep dive into what feels like an existential crisis for the EU. We've got Mario Draghi's do-or-die report on competitiveness. We have the raw defense data and some pretty chilling speeches out of Munich.
Right.
And our mission is simple. Can the EU shift from its whole Green Deal focus to what some are calling the metal era, rearmament, industrial survival,
Right.
before it all just falls apart?
Well, the term Draghi used was slow agony, and honestly, the data really backs that up. You have a union that is squeezed between a protectionist U.S. and a state-subsidized China.
And his diagnosis is stark.
It is. He says for Europe to just stay competitive, not even lead, just to keep up, it needs an extra 750 to 800 billion euros. every year.
Okay, let's stop on that number for a second. 800 billion euros. For context, the Marshall Plan, which literally rebuilt the continent, was what, 1 or 2% of GDP?
Something like that, yeah.
Draghi is asking for 5% of GDP every single year.
It's a war economy level of investment, but in peacetime. And the reason the bill is so high is that the rot is, well, it's structural. Europe's industrial base is just static. We largely missed the digital revolution.
I saw that stat. Only 4 of the top 50 tech companies are European. 4.
Right. And it's not just tech, it's the basics.
The energy costs. You can't compete when your energy is 2 to 3 times more expensive than in the US. It's like running an AI economy on a dial-up budget.
That's the perfect analogy. And because the market is broken into 27 different pieces, we're now at risk of missing the clean tech wave too. But look, economic fragility is one thing.
It's the geopolitical timing that makes it a crisis.
Exactly. Fast forward to what we just saw in Munich, it feels like the whole idea of Atlanticism just collapsed.
It's gone. With Trump back and J.D. Vance giving those speeches, that old assumption of a permanent U.S. security umbrella, it's just vanished.
Evaporated. And you see the panic when Trump starts talking with Russia about Ukraine without, even having Kiev in the room. Europe realizes it is on its own.
For me, the real tell is Friedrich Merz. This is the ultimate Atlanticist ex-BlackRock. For him to now be framing the U.S. as a rival, that shows how deep the crack is.
It forces a total rethink. So, on paper, the plan is strategic autonomy. You have von der Leyen pushing this clean industrial deal, the battery booster package.
Right, build our own stuff.
Build our own stuff. But there's a huge gap between the plan and the reality.
Oh, look at Northvolt, the great European hope for batteries, right? Now they're cutting jobs, selling off divisions, not because they lack talent, but because they can't compete with Chinese subsidies while paying Europe's energy prices.
Precisely. And that throws you right into the guns versus butter dilemma.
Yeah.
Can Europe fund this massive military buildup? We're talking NATO targets maybe going to 5% GDP without just dismantling the welfare state.
The thing is, the numbers suggest they're not even building the capacity. They're just spending the money elsewhere. This is the stat that kills me. From mid-2022 to mid-2023, 78% of Europe's defense buys were from non-EU suppliers.
Mostly from the United States.
Exactly. So we're talking about strategic autonomy while writing billion-euro checks to the very power we're supposedly trying to become independent from. It's totally incoherent.
It really is. It just highlights the paralysis of the 27-member system, which brings us to Draghi's solution. He calls it pragmatic federalism.
Which is a nice way of saying let the slow ones fall behind, isn't it?
In a way, yeah. A coalition of the willing. The nations that want to integrate their defense industries and energy markets just go ahead. Stop waiting for everyone else.
But that's a huge risk. You could end up with a 2-tier Europe. You might break the political union just to save the economic one.
That is the gamble. But the alternative is that slow agony we talked about. And I think this leaves you, the listener, with a really provocative thought. We fixate on the 800 billion euro gap, but money doesn't buy sovereignty. If Europe can't even agree on a single energy grid or one defense market, does the amount of money even matter? Or is the political structure itself the fatal flaw that no amount of cash can fix?
Welcome back to The Deep Dive. It's Saturday, February 7, 2026. And if you've been glancing at the headlines this morning, you know all eyes are on Muscat, Oman. We're going to be digging into the resumption of nuclear talks between the U.S. and Iran. This is a meeting that honestly felt almost impossible a few weeks ago. We've been pulling together reports from Axios, the Wall Street Journal, and Al Jazeera, plus official statements to figure out what is actually going on.
And it is quite a picture. You've got this mix of diplomatic progress and, military brinkmanship happening all at once. So our mission today is to understand not just that these talks are happening, but why the terms seem to have shifted so dramatically, really just in the last 24 hours.
Right, because the logistics alone tell a huge part of the story here. I was reading that this was all originally supposed to happen in Turkey with a much wider guest list, Saudi Arabia, Egypt, the works. But then yesterday, bam, everything moves to Oman. That feels significant.
Oh, it's hugely significant. And it wasn't an accident. That was a specific last-minute demand from Tehran. Moving it to Oman, they basically strip away the whole NATO backdrop. But the bigger move, the real curveball, was the agenda.
The agenda?
Yeah. Iran managed to narrow the entire scope strictly to the nuclear file. They flat out refused to discuss ballistic missiles or their regional proxies. And for the U.S. to accept that was a major concession just to get them to the table.
It does seem like the U.S. gave up a lot of ground just to get the meeting going. But then you see the pressure from the region, and it starts to make a bit more sense.
Exactly. You have, 9 different Arab governments heavily lobbying Washington. They are terrified that a failure here leads to a full-scale war. I mean, war that would just devastate their economies.
And that's the driving force. You have to remember the context of the last year. We're still in the shadow of those June 2025 strikes.
The U.S. and Israeli strikes on Fordo, Natanz, and Isfahan.
Yes.
The region is already on a hair trigger. And on top of that, the regime in Iran is dealing with these massive domestic protests that kicked off back in December. They are being squeezed from all sides.
And then there's the technical reality, which is driving all this urgency. The latest data shows Iran is enriching uranium to 60% purity. The stockpile's now nearing, 9,870 kilograms.
And that's the critical part. People hear 60% and think, well, it's not 90%. But that's a misconception.
The physics aren't linear, right?
Not at all. Getting to 60% is the hard part. The jump from 60 to 90%, that's weapons grade, is technically very, very short. It's a sprint, which is why that stockpile number is so alarming to Western intelligence. They can break out fast.
Which explains the whole maximum pressure campaign from the White House. Just yesterday, they sanctioned 14 more ships in Iran's shadow fleet. For anyone who doesn't follow this, these are basically ghost ships, right?
Yeah, old tankers. They turn off their transponders, paint over their names. Anything to smuggle oil and keep the cash flowing. So sanctioning them is a direct hit on their economy. And President Trump, speaking from Air Force One, he didn't mince words. He said he believes Iran wants a deal, but his bottom line is no nuclear weapons.
But the Iranians are playing their own game with their own military assets. It's this total split-screen reality.
It is. While the diplomats, Special Envoy Steve Witkoff and Foreign Minister Rachi, are shaking hands.
You got an Iranian Shahed 129 drone buzzing the USS Abraham Lincoln.
It's classic leverage. The diplomats are calling the talks a good start, but the Revolutionary Guard is signaling they can still shut down the Strait of Hormuz. That drone flight and the fact that their boats harassed a U.S. tanker right before the talks, that's them saying we are negotiating, but we are not surrendering.
And it absolutely rattled the markets. Oil prices dipped 2% just on the rumor of talks. That shows you how much risk is priced in.
It does. And it brings us to the real core of the issue. We have this fragile diplomatic opening, but it's hyper-focused on this one thing, the nuclear material, while completely ignoring the missiles and the regional militias.
Which leaves us and you with the big question to think about. If a deal explicitly ignores the missiles and the proxies that are actually doing the fighting on the ground, are we building a real path to peace? Or are we just hitting the pause button on the next war?
That is the gamble.
We will be watching this all week. Thanks for listening to The Deep Dive. Okay, so it is Saturday, February 7th, 2026. And this week has been, just nuts.
It really has.
We have a U.S. F-35 shooting down an Iranian drone. We have Nicolas Maduro captured, which has led to this huge Venezuelan blockade.
Yeah.
The ceasefire in Ukraine. Gone.
And yet, if you look at the markets, Brent crude is sitting at $55 a barrel. It makes no sense on the surface.
It's a total decoupling.
Right.
So that's our mission for this deep dive. We're going to unpack this tug of war between the headlines and the hard data.
Right.
I've been digging into the new IEA reports and an analysis from the European Central Bank, and they keep coming back to this idea of a buffer zone.
That's the perfect term for it, because the spike drivers, the F-35, Venezuela's exports being slashed to 300,000 barrels a day, those are very real.
Oh, absolutely.
But the drop drivers are they're so much bigger, they're completely overpowering them right now.
And that's all about supply, isn't it?
Yeah.
The map has just changed. I was looking at the non-OPEC numbers. It's not just the U.S. anymore.
No, not at all.
You've got Brazil, Guyana, Argentina. I mean, they're all pumping record amounts. It feels like they're flooding the market.
They are. The structural surplus is just massive. But there's a deeper reason this is happening, something psychological that the ECB report really, really highlighted.
Okay.
They call it the economic activity channel. It explains why war isn't causing price spikes like it used to.
This was the most fascinating part of the research for me. It's about the timing, right? The lag time.
Precisely. The fear of a conflict, the fear of recession, it spreads instantly.
So factories slow down, ships cancel routes, consumer demand just dies overnight.
It dies. And that demand shock hits the ledger about 3 weeks faster than any physical supply chain can actually be disrupted.
So the fear of recession drags prices down faster than the bombs can blow up pipelines to send them up.
You got it. The market price is in the slowdown immediately, and it just cancels out the supply risk.
Well, we did see a little blip this week, didn't we? That that weird spike.
Right, the fake breakout.
Prices shot up for maybe 6 hours before they crash back down. That has to be the algorithms we keep talking about.
It is. The data we're seeing shows that algos are driving the volume in 80% of trading weeks now. These are not people making careful judgments.
They're just headline-scraping bots, so they see a keyword like Strait of Hormuz or drone.
And they execute huge buy orders in milliseconds. They're buying the headline. But here's the disconnect.
Yep.
The physical traders, the people actually moving barrels of oil on ships, they aren't seeing any shortages. So when the bots create that artificial spike,
The humans sell into it. They crush the rally because they know the surplus is real.
exactly. And that mechanism is why the price you pay at the pump isn't really moving.
Which is the silver lining here for everyone listening, that human correction is keeping gas prices projected around, what, $2.90, $2.97 a gallon?
Yeah, which adds up. It puts about $11 billion back into U.S. consumers' pockets this year.
I will absolutely take the savings. But looking at the IEA's long-term forecast, this feels like a trap. We're celebrating cheap oil now, but the investment numbers are frankly terrifying.
It's the deficit narrative. We're eating our seed corn. 90% of global oil production is coming from post-peak fields. They're all in natural decline.
And the industry is spending $500 billion a year just to keep production flat, not to expand, just to tread water.
So when oil is $55 a barrel, there is zero incentive to go look for more. We have a surplus today, but we are building a massive deficit for, say, 2030.
And that leads to the really provocative idea in this week's research stack.
The substitution paradox.
Just flips the whole green energy narrative on its head. You think of the transition as, switching from dirty to clean.
But the transition phase itself is incredibly dirty. It might be the most fossil fuel intensive project in human history.
Think about it. You want to build wind turbines and batteries. You need to mine unbelievable amounts of lithium, copper, cobalt.
And you can't mine copper with a solar panel. You need giant diesel machinery. You need immense amounts of hydrocarbons to smelt the steel to manufacture the solar panels themselves.
So to get off oil, we first need to burn a historic amount of oil just to build the new infrastructure.
But we aren't investing in new supply because the price is too low thanks to this buffer zone we're in.
That's the danger.
So the question I think we should leave everyone with is this. Are we celebrating cheap gas today while completely underinvesting in the very energy we need to build our renewable future?
If we starve the oil industry of capital now, we might not have the fuel to build the lifeboat later. That is a heavy thought to chew on. Thanks for diving in with us. We'll see you on the next one. Welcome to the Deep Dive. It is Saturday, February 7th, 2026.
And looking at the stack of research today, there's a real dissonance in the headlines, isn't there?
There really is. I mean, you look at one screen and AI is just dragging the market to record highs.
And then you look at the other and we're dealing with, sticky inflation and these fractures in global trade.
It's a complete split-screen reality.
Yeah.
I think JP Morgan's outlook for 2026 had a name for it.
They did. They're calling it multidimensional polarization.
Which is a very precise way of saying the world is pulling in two totally opposite directions at once.
Mm-hmm.
So our mission today is to reconcile this resilient economy that's powered by an AI supercycle.
Against a 35% probability of a global recession just staring us right in the face.
Exactly. It creates this unbelievable tension. You have record corporate spending on technology.
But then you have softening demand for actual human labor.
It's the definition of a K-shaped recovery, right? If you're in that tech bubble, life is great.
But if you rely on traditional labor or, say, global shipping, things are much, much harder.
And the one thing hitting both sides of that K-shape, inflation, just stuck at around 3%.
And that stickiness, it's not just about supply and demand anymore. It's about conflict. You flagged that Yacoviello paper earlier.
I did, yeah. That paper was the key insight for me here. Because, historically there's this debate that war is good for the economy.
The old World War II production boom argument.
Right. But his research says that in a modern context, geopolitical risk is purely stagflationary.
Meaning it raises inflation while it kills growth.
It's the worst of both worlds.
Yeah.
Because modern conflict isn't about building tanks.
It's about breaking supply chains.
Which basically acts like a tax on, everything. We can see it so clearly in the trade data.
Oh, absolutely. That ING report was forecasting global trade growth of only, 0.5% to 1% for 2026.
It's basically stagnant. And it's policy-driven stagnation, too. We're seeing the U.S. lean really heavily on the IEPA.
the International Emergency Economic Powers Act.
which just lets the president regulate commerce. So in practice, that just means more tariffs and less efficiency.
Efficiency is out, barriers are in, and it's not just policy. Just look at the South China Sea.
$5.3 trillion in annual trade passes through there.
Through a zone that is getting more and more hostile, insurance premiums are soaring.
Which means ships are taking longer, more expensive routes, and that cost, it gets passed right on to the consumer.
We're even seeing this kind of fear pricing in energy. Brent crude hit $68 recently, not because a pipeline blew up.
No, it was just the threat of Iran-US escalation.
Exactly. Analysts are calling it status quo nervousness. The market is pricing in things that haven't even happened.
Which is a perfect segue to the human element here. I mean, we can look at macro charts all day long.
But individual investors are human beings.
And that Harsono study in our stack suggests our brains, they just aren't built for this kind of multi-dimensional stress.
It's about the subjective experience of volatility. The study found that fear of loss, it completely overrides rational analysis.
So when the headlines get scary, like they are now,
People tend to panic. They liquidate assets, and usually at the absolute bottom.
so to stop yourself from doing that, from panic selling, you need a buffer. And the sources from Fidelity and JP Morgan, they both highlight a safe haven strategy.
And the big headline there is gold. JP Morgan is forecasting gold could hit $5,000 an ounce.
By year end, that's a massive number.
It is, but it starts to make sense when you see that central banks are the ones buying it up. They're diversifying.
But for the individual, it's not just about gold.
No, not at all. They're also pointing back to developed market government bonds as a stabilizer.
And good old-fashioned cash.
Cash is dry powder. It gives you optionality. If the market dips because of some geopolitical scare, you have the flexibility to actually buy.
Fidelity also had a note on defensive stocks, utilities, consumer staples.
Yeah, the boring stuff. Boring is good when you're trying to avoid becoming a forced seller. You want enough stability so you can sleep at night.
It all comes back to that initial idea, that multi-dimensional polarization. You need a portfolio that can handle both things at once.
The AI boom and the geopolitical bust.
That's the challenge. Because we are leaving the era of just-in-time efficiency.
And we are entering an era where we have to pay a premium for security.
A security tax.
Yeah.
On everything. We're paying more for energy, for shipping, for goods, just to make sure they actually arrive.
That is the reality for 2026.
And that, I think, is the thought to leave you with. If efficiency is dead, are you still investing for a world that no longer exists? Or are you building a portfolio for survival? Thanks for listening. We'll see you next time.